Hello, everyone. Good afternoon. I'm really happy to be meeting all of you for the first time. And so I will take you through the macro trends of what we saw in 2025 in terms of the resilience of tourism. And then my friend Debbie will take you into the depths of the hotel data performance nationally as well as for BC. So 2025 was a year marked by geopolitical and macroeconomic uncertainty. And as Paul said in the morning today, it started with tariff gate and was followed by a lot of global headwinds. However, tourism as a sector remained resilient through all these headwinds. And we have data to back that. Tourism GDP grew at 2.2% as opposed to the overall economy at 1.6%. Tourism employment grew at more than twice the rate of the employment for the overall economy. And when we look at the forecast of the tourism revenue growth from 2025 to 2030, again, the growth in tourism at 5.3% annually up until 2030 outpaces the growth in the overall Canadian economy. Now, this slide shows what we are grappling with currently. The Global Uncertainty Index was at its highest in 2025, which was higher than the previous two peaks. In 2022, it was the Russia-Ukraine war, and in 2020, it was the global pandemic. So essentially what we are saying is in 2025, the uncertainty was at its all-time high, even higher than the global financial crisis in 2008, 2009. Now, this is one slide that I really want it to be one of the key takeaways for everyone in this conference. And I want to thank Beth for emphasizing this in the morning, that tourism is a high growth export with fast returns. Now, it may not be very intuitive as compared to traditional exports. Let's take an example here. So suppose there is a canola oil exporter who exports oil to Mexico. Now, the Canadian exporter exports the oil gets shipped to Mexico, the importer buys it, and the oil gets consumed by a Mexican consumer. So that is how we know exports, right? It is getting consumed in a foreign country. However, when a Mexican resident arrives in Nanaimo and buys a meal at either the Red's Bakery or the Bucco Cafe, or takes a ferry to the Newcastle Island, that's also an export, even though the consumption is happening within Canada, because the international resident is spending international money, whether it's dollars, pesos, or rupees in Canada. So in 2025, the total tourism exports or international tourism revenue, we call it interchangeably, was $31.5 billion. And this made us one of the top 3 Canadian service exports, greater than financial services and greater than professional and management services exports. And again, as Beth alluded to in the morning, one of our national long-term economic goals is to achieve the doubling of the diversification of non-US exports and reach $300 billion by 2035. And based on Destination Canada estimates, tourism over the next decade is going to contribute 9 to 10% of that diversification goal. The other aspect is tourism doesn't just contribute to the direct exports. According to a latest report by Destinations International, a 1% increase in inbound international arrivals to Canada increases the total exports, both goods as well as services, by 1.06 billion over the next 2 years. So there is a wider economic multiplier effect of tourism as well. One of the key features of 2025 that we saw was broad-based growth in tourism with geographical dispersion. So here we show the growth that happened across the 122 tourism regions in Canada. 105 out of Canada's 122 regions, which is approximately 86% of the tourism regions, showed a positive growth rate in 2025. And almost 80% of these regions grew at a rate higher than MTVC. After joining the tourism industry, I'm also starting to learn some jargon. So Montreal, Toronto, Vancouver, and Calgary. So when we look at the growth of these major regions, 80% of the tourism regions grew higher than these 4 regions combined. So that really shows that people are traveling far and wide and not just remaining confined to the major tourism regions. Now let's look at BC. Again, a very similar performance. 25 out of BC's 29 tourism regions, which is again approximately 86%, showed positive year-over-year growth in tourism-related spending. And the remarkable aspect is most of this growth came from inter-provincial spending. So it came from people who are traveling from other provinces to BC. There was some decline in spending by US residents. That is because overall arrivals from US, especially the land arrivals, declined in 2025. Now, the other key feature about last year was how overseas residents traveled to Canada. I'll take a slight detour here. When the tariffs struck in 2025 February, starting of February, so Destination Canada started with something that we call as the Market Signals Report. It's something that we produce every month in order to track indicators right from the upper funnel to the lower funnel. And what we observed for the first 2 months, February and March, was overseas travel and sentiment to both US and Canada had declined. And we were a bit skeptical that overseas travelers probably are avoiding travel to North America altogether because of all the geopolitical disruption happening down south. However, as a famous line from P.B. Shelley's poem, Ode to the West Wind goes, can spring be far behind? And owing to the efforts of each and every person in this room and the remaining of our 2 million tourism workforce, we made a turnaround in spring. And as you can see, in May, from May to December, the overseas air arrivals grew by 5.8% year over year. And this, we are talking about DC's target markets, which is Mexico, UK, France, Germany, Australia, South Korea, China, and Japan. But what's more interesting is how they travel to Canada. So 87% of them travel to Canada directly or via any other overseas country, and 13% of them travel to Canada via US. There was an 8.8% growth in travelers who are traveling directly to Canada or via other connections, but a double-digit decline when traveling via US. This has important implications for us to work on improving the direct air connectivity between Canada and the other countries, because there has been a little bit of a reluctance amongst overseas travelers to travel via US. When we focus on BC, the growth or the resurgence has been even better. There was a 9.3% growth in our air arrivals from DC international markets between May to December. The mix is the same. 87% of them travel directly and 13% of them transit via US. However, the growth while traveling directly to BC or via any other overseas market was 12.2% as opposed to the 6.7% decline while traveling via US.
Perfect. So by now, I think most of you know STR, or at least our STAR reports. We are like the report card for the hotel and destinations, and we help hotels and destinations understand how they're performing against everyone else so they can make the smartest decisions with regards to revenue management, sales and marketing, or even inform a hotel owner operator where they want to buy or build their next hotel. So let's look at our next report card, look at our most recent report card across Canada. Not that it's a competition, but as of July 2025, and for the first time ever in 15 years, Canada has overtaken the US in annualized RevPAR. The global uncertainty, yes, take that round of applause. Definitely the global uncertainty caused by the current US administration has caused a lot of turmoil, and Canadian hotels are seeming to benefit from this. Canada continues to trail the US in average daily rate, but the gap is narrowing, currently less than a $6 advantage for US hotels. It is with occupancy that Canadian hotels are outperforming. For more than 2 years now, Canada's annualized occupancy has been well above that of the US, currently a 4-point advantage for Canadian hotels. Currently, we're looking at the 12-month moving average. But when we switch that to the monthly look, you'll be able to see seasonality. So you can see here that the US does have a slight occupancy advantage in the winter months, but nothing like the clear domination Canada has during the summer. And during this past August, and you can applaud again, Canadian hotels broke the 80% mark and nearly saw 15 points occupancy advantage over American hotels. Congrats. So moving forward to our provincial Canadian report card for 2025, overall Canadian RevPAR was up 4.3%, of which 3.5% of that was average daily rate. Interesting, BC was the only province to have higher gains in occupancy than they did rate. So 2.3% increase in occupancy, 1.6% in ADR. That may have been impacted in 2024. We will all remember, or many of us will remember, that Taylor Swift effect in both Vancouver and Toronto. So that 2024 ADR was extremely high and difficult to match, I guess, in 2025. But definitely, mainly, many cities and provinces benefited from the proud Canadian sentiment that we've been experiencing. So now let's take a closer look at the performance right here in BC. And as usual, BC leads the country in performance. For annualized RevPAR, BC has 6 of the top 10 submarkets in Canada. Whistler continues to be the #1 spot, and Vancouver submarkets make up for 3 of these top 10. And here's a snapshot for all of the BC submarkets, and there's quite a few of them, so we've put it into 2 different slides. Our BC average was 4% RevPAR, 2.3 of that was occupancy, and 1.6% in ADR. Interesting that the Cariboo Coast is primarily, their growth was primarily in occupancy. Of that 5.4%, 5.1% of that was due to occupancy growth. And then Kelowna, Nanaimo, and South Okanagan achieved double-digit growth. Want you to take a look at that South Okanagan number because it's going to come back in when we look at 2026. And in this set, only Northern BC achieved RevPAR decline as a result of a 2.2% decline in occupancy. So in the second half of our BC submarkets, Vancouver North, Vancouver South Surrey area all saw declines in occupancy, while Victoria and Whistler and Vancouver Island North saw very healthy occupancy and ADR increases. So I'm going to pass this back to Vijay for our near-term outlook.
Thank you, Debbie. So now we look at the near-term outlook, and here I'd like to say a big thank you to Ashley, who had to work till the last moment to update these slides because this data we received from StatScan just yesterday for the leading indicators on arrivals. So when we look at the Jan to March growth in overnight arrivals for overall Canada, air arrivals grew by 5.9%, and as you can see, there was growth from all our target markets and even from rest of the world. And the good thing is, US is trending higher than what we saw last year. But the more remarkable turnaround, I would say, happened in terms of US overnight land. Because from February 2025 to Jan 2026, there was a continuous decline in US overnight land arrivals to Canada. However, in the last 2 months, it has turned around and we have seen positive growth from US overnight land, which is great news because in terms of the number of arrivals, not the spend, but the number of arrivals, US overnight land constitutes a higher proportion of the total arrivals from US to Canada. When we look at BC, the momentum continues and it looks even more robust than for the rest of Canada because for the first 3 months, we are at 9.6% higher than last year for the same period. And this is in terms of the overnight air arrivals. And as we can see here again, growth across all markets. The growth from US is really encouraging at 8.3%, slight decline from France, but otherwise growth across the board. And however, one thing of concern is as opposed to the trend that we saw for overall Canada, where we saw a resurgence in the land arrivals too. However, for BC, there's still some softening in the overnight land arrivals as it continued to decline in Feb and March. Over to Debbie.
Okay, so unfortunately, our full Q1 results aren't ready yet. We should have those out for you next week. But if we look at January and February, we can look at our first group of BC submarkets. So overall, very impressive BC growth of 9.1% RevPAR growth for the first 2 months of this year. Very healthy 5.7% increase in occupancy and about a 3.2% increase in RevPAR. So many positive results in this first group of submarkets, including four of them being over the BC average. With the title for the largest RevPAR growth in all of BC goes to the South Okanagan, and that's pretty remarkable considering that they had double-digit results in 2025. So congratulations to any of you that sit in that submarket. And then, sorry, that's it. Go ahead. So in this final set of BC submarkets, Vancouver Island Southwest is the only BC submarket to see RevPAR fall so far this year. And again, many positive results. 5 of these 9 submarkets are ahead of the BC average. So in the US, and for most of the world for that matter, we're talking about a K-shaped economy or a bifurcation, where luxury and higher end hotels are doing better than the lower end and where they seem to see performance decline. Here in Canada, though, it's not a K-shape at all. It's more like a smiley face economy. So where both ends are rising higher than the middle, and with growth like this, hopefully hotels will be smiling. So looking forward to FIFA, we are so excited to be one of the host cities, or Vancouver is so excited to be one of the host cities for the world's greatest party. We've always known that we are going to be very successful in ADR. Occupancy is always very strong in British Columbia during this time of year. So what we're seeing here on this slide is a little bit of a mixed results. The green information is where we are this year. The blue line indicates the same time last year. When we're looking at the Vancouver market, it's also important to understand that this includes all of the Vancouver submarkets. So we're looking at downtown Vancouver, we're looking at the airport, we're looking at North Vancouver area, we're looking at South Surrey and the Fraser Valley. So this encompasses all of them. So very mixed results. There's dates in May and June that seem to be doing very strong. That spike that you see last year in July was when Vancouver hosted the Alcoholics Anonymous annual convention, which was, brought a lot of people into the city. And then if you look towards, after the FIFA World Cup, the months of July, August, most of September and October seem to be very strong as well. We've done the same exercise for the Victoria submarket, and again, a little bit of mixed results. And if you recall, Victoria grew in occupancy about 5% last year. They had a very strong 2025. So there are periods of time where they're exceeding their pace of occupancy on the books, but there are some definite declines as well. So with all this in mind, let's take a look at our forecast for the Canadian hotels. So I just want to explain that about 4 times a year, CoStar, in conjunction with Tourism Economics, do these very high touch forecasts. We do it for Canada, Vancouver, Toronto, Montreal. This past slide that we're looking at right now was produced in February. That wasn't a long time away from a calendar perspective, but of course we know so many things have changed between now and then. So our next forecast will be out in August. But if we take a look at the Vancouver market, definitely there is some growth from 2025 to 2026. So we're looking at a 2% occupancy increase, a 4.4% ADR increase, and a RevPAR increase between 6.5% to 7%. So definitely good news for Vancouver. We've also put together a forecast for the province of British Columbia this time, and here the growth is not in occupancy overall in the province. So we're looking at a 0.5% occupancy increase, but then very healthy increases in ADR, $17 increase in ADR across the province, and a $14 RevPAR increase, or an 8% RevPAR overall. So that's very positive news.
So now we look at the pacing of the air forward bookings from international markets to BC. This has been pulled up. The cutoff date for booking is 28 February. So this does not include bookings made in March. And as we can see, we are pacing ahead of the same time last year for most of the months, except for marginal decline in April. And this is for all international markets to BC, including US. And when we look at domestic to BC, because one of the hypotheses was that during the FIFA months, probably because of a lot of crowd in and around Vancouver, maybe there could be dispersion from domestic travelers to other provinces. However, so far, and again, the cutoff date being February 28 in terms of the booking date, we see that the pacing, especially for the summer months and the FIFA months, is ahead of what we saw last year. This might change as we move closer to the travel date, but as of now, this is the situation. And also, this does not include the month of March. And we all know the Iran crisis started in the end of February. So we are yet to see what would be the impact of March on the bookings and cancellations. So finally, the decade of momentum. I'm very pleased to inform you that this is from our forecast, which we are yet to publish. Hopefully, we'll be doing it this week or the next. So I'm really happy to be able to present this in front of you. So as per the results that we got from Statistics Canada, we clocked $132.9 billion of total tourism revenue in 2025. And based on the forecast done by Destination Canada and Tourism Economics, we are projected to reach $177 billion by 2030, which represents a 5.3% annual growth from 2024. And the good news is when Destination Canada published the strategy, 2030 strategy, A World of Opportunity, we had a target to reach $160 billion in total tourism revenue by 2030. However, we have hit that target as Team Canada 2 years ahead. So we are hitting $160 billion in 2028 instead of what we had envisaged of doing 2030. So that's great news. Finally, this is what the projected share of total spending would look like as per our outlook in 2035. The red rectangle is the share of domestic tourism revenue, which will constitute 68% of the total tourism market and is projected to grow at a CAGR of 3.6% over the next decade. The other one is overseas tourism spending, which will constitute 19% of the overall tourism market and is projected to grow at a CAGR of 9.8%. And it is this higher growth in overseas tourism spending which will help us to meet 9 to 10% of the $300 billion non-US export goal. And finally, we have the 13% share of US, which is projected to grow at a CAGR of 5.3% over the next decade. Now, to summarize this, I would like to take an investment analogy. Think that you have an investment portfolio. The Canadian tourism or the domestic tourism revenue is like the highly rated government bonds. Very safe and low risk, however, slightly lower return than the other stocks and mutual funds. But it is like our all-weather friend, staying through us through thick and thin and through all disruptions. So that's our domestic tourism revenue. The US tourism revenue is more like ETFs or mutual funds. Slightly riskier. However, they also bring in a slightly more return. When I say return, I mean yield or the spending per traveler. And finally, we have the overseas markets, which are more like individual stocks, which are financially strong, well-governed, and efficiently managed. However, they also carry a higher risk, but also a higher return in terms of the yield. So for us to really be competitive and to meet our long-term aspirations and to meet our forecast by 2035, we need to have a well-balanced, diversified portfolio that balances for the risk as well as return. So, yeah, that's it. And thank you.
Thank you, everyone.